Takwa FX here again. Good morning to everyone. So guys, today we are going to look at advanced market structure and how you can enter the market once the market maker has given you the footprints, as in once they are drop their stop losses, they have liquidate other people, and how you can join them to go in the direction they're expecting to. So let's get to the chart. So guys, don't forget to subscribe to the channel, turn on the notification bell so that whenever I drop a new video, you'll be among the first people to learn something from it. So let's get to the chart. Right here, I'm using US 100, US tick. That's how the most people call it. So I'm on my H4 using US tick. So this is the first pattern we are going to be looking at in the market. This is first structure we are going to be looking at today, and the second one will come later. So this very structure, you can see this market is going up. It's going up. Yes, the market is bullish, is going up. Then at this point, we see that this market broke structure. This is trend line, meaning that this trend line will serve as liquidity. We'll talk about that. We'll talk about liquidity when next. So you can see that the market broke structure to the downside, leaving this zone. It leaves this zone. That will be your point of interest because we have a BOS right here. I'll show you the difference between these two patterns when we are going to take a trade using using the second method. So you see two difference of market structure. So you see that the market broke structure. It broke structure to the downside right there. So let's name here our BOS. So that is it. The zone right there is our POI, while the one below is our BOS. I'm not too good at drawing. That is why that place, this very point is like that. So there is no problem. So this is the first one we are going to look on the chart today. And let's go for the second pattern we are going to be looking at. The second pattern is something like this. Instead of us using this value zone as our BOS, instead of us using this very zone as our point of interest, no, we are not going to be using this zone. We are going to be using this very one as our point of interest. So that is the second one, which means that this very one now, which is our POI, is no longer our POI. It serves as liquidity. This very point becomes our POI. So you can see the first POI now, which happens around this point, that happens around the point. So that point now becomes our liquidity. While this first leg here, this first high now becomes our point of interest. If you can check very well from here, can check very well from this point right here to this high, it's pushed to the upside and it left this zone. Then after the market was trying to make another leg to the upside, it failed. There was no bullish pressure again to push the market up to the upside, and it comes back down and break this very structure that lead to this high, that lead to the first high. So the market came back and took out that structure. That was how we were able to map out this very zone here to be our first zone, which if the market comes into it, we look for we look for an entry criteria at that spot, then we take our trade down to the upside. Then here becomes our second zone, which the market will come instead of it to stop at this zone and goes to the downside. It will come and take out this very, because you can see it now becomes equal highs. Equal high serve as a liquidity in the market, so it becomes equal high. So out of this point, the market is seeking for a liquidity for it to be able to move and make their profit. That was the market maker does. So they are looking for where liquidity lies for them to take it out and then goes in their direction. So that this is what happened around this zone, as you can see. So let me give you what the market will eventually do. So now you can see, instead of the market to stop at that our first zone, it varies up to the upside to this POI, and it fell from here to the downside. So that is the first and the second market structure we are looking at today. So this is US 100. You can see that this market has been on a downtrend. It was trending to the downside. If you can see this trend line which I drew, you can see that this market, from this very zone, that was the last high the market created before it broke structure to the upside. This is before it breaks structure to the upside. So this is the first scenario that I show you guys using bearish using bearish using bearish trend. So this is it. Using bearish trend, you can see that after this trend line, here was the last high. Here was the last high before the market break to the upside. So there was the last high. There was the last high. And the market break to the upside. It created all these weeks and still break structure again to the downside, to the upside. You can see that this zone still remain intact. The market hasn't tapped into this zone yet. It's still intact. So what happened is, today this market come into this very zone. As the market comes back into the zone, that is where you are going to take your trade from. That is where you are going to take your trade from. Then you TP the high right here. That is where you are going to TP, or you look for H1 zone inside this range and you TP. You don't have to be greedy. You go to a smaller time frame and you take a trade right there. Like what I do, I don't just take a trade. I have to, this zone which I marked, this very zone here, I have to make sure that on this zone I'll move down to H1 candle inside this zone to mark out as my OB, the last down candle before the break of structure to the upside, which is this very one, the last bearish candle before the last bearish candle before the up move is on that zone. You can see that is the last candle before the move to the upside. So we mark that out and we stretch it to this zone. to make sure that the market comes into it. We stretch it forward to make sure that the market comes into it. As the market comes into it, you can either use an engulfing pattern or a shift in market structure to enter your trade to the upside. You can either use a bearish structure, sorry, um, a bullish, an engulfing pattern to take your trade. You can either use your engulfing pattern to take your trade to the upside, or you wait for a shift in market structure and you take your trade to the upside once the market come into this zone. So that is it for this setup. So let's look out for the second setup. So guys, for the second scenario, I'm going to be using gold chart, still 4 hour. Let's check out our structure first. We can see that the market has been going up. Here was the first low, the market. Here was the first footprint the market dropped before it rallies up. Then what happened is the market came back and it closes below this zone. You can see we don't use a week to frame a market closure. We don't use a week. We have to use the full candle. The candle has to close below wicks for us to identify it as a break of structure. So if you can check this very place very well, you can see that here was the zone that lead to break of this structure. Here, this is the very last candle that lead to the break of structure. But what happened? This very zone now serve as liquidity for us. Mark, note, this very zone now serve as liquidity for us. And the market comes into this very previous zone, which is this one. The market come into this very previous zone, which is this, because that was the first high the market created. So the market come into that zone. That is when you are going to look for your entry criteria to take a trade. It's either you wait for the market to break structure to the downside when you go to either M15 or 30 minutes for you to take a trade. So as the market tap into that zone, you go to your either 30 minutes or M15, depends on you what you really want. So you want the market to tap into the zone and break structure to the downside, which it happens. Once the market breaks structure to the upside, that shows you that the zone is very strong. We can see it broke structure to the downside. Now that is when this very zone, this zone here, becomes your point of interest. You stretch it back to the future and wait for the market to come in. So you place your trade right there. The last, as you can see, we always make sure we take our trade on the last candle before the down move. So here was the last candle. So here, this zone, there was where our last candle took place before the down move. So we place our trade right here. As the market come into it, we place our trade, and you can see the market rallies back down. You can see. So that is how it is. That is how it is. That is how it is. So guys, if you have watched this video till this point, this means that this video has been useful to you. So subscribe to the channel, turn on notification bell, so whenever I drop a new video, you'll be the first among people to view and learn something from. So if you have any comment on a topic I can shed light on, then you can drop your comments. That is why we are here. Let's grow together. So likes, comments on the channel. I remain Aqua FX as I sign out.